Let us talk about inflation today. The government of India has retained the 4% retail inflation target with a plus minus 2% band. For the next 5 years, that is from 1st of April 2026 to 31st of March 2031, reinforcing the flexible inflation targeting framework adopted by the RBI and Monetary Policy Committee in our country in 2016. And this marks the second such extension since March 2021, ensuring long-term macroeconomic stability. Now, this is what the news is all about. Now, in order to understand this particular news, first of all, we need to understand what is inflation. Then we need to understand what is inflation targeting, and then we need to understand about what is flexible inflation targeting. See, in very simple words, inflation refers to increase in prices of goods and services in a particular economy. But mind you, this increase in price should not be all of a sudden, which means steady and sustained increase in price of goods and services is what you will call as inflation. If the price spikes of a petrol, if the price spikes of, let's say, food items, tomatoes, we won't call it as inflation. We will call it as temporary price fluctuations or temporary price shocks. And also one more thing is there, that inflation doesn't mean increase in price of one single good. Inflation means increase in price of a basket of goods and services which are being used by the people of our country. Which means that if price of one commodity increases, we won't call it as inflation. Although it may be due to inflation, but we won't term that particular situation as inflation. Inflation occurs when in tandem, a lot of goods and services, the basket of goods and services, their prices increase. That is a very technical, particular definition of inflation. Now, inflation targeting means that in order to target a particular rate of inflation, RBI creates its monetary policies, or RBI modifies its monetary policies. See, one thing we need to understand over here is that inflation impacts and affects each and every of our lives, each and every sphere of our lives. All the things which we buy, all the things which we consume every single day, we are price sensitive. And price decides what we are going to consume, mostly for the middle class and the lower class people. Which is why targeting inflation is the major role of RBI. One of the major role which is played by the RBI is inflation targeting. And one of the major reason monetary policies are framed in our country, are changed in our country, is to ensure and stabilize inflation in our country, stabilize price in our country. Because price stabilization is quintessential for today's world and for today's economy. Now, since we have understood about inflation targeting, let us talk about flexible inflation targeting. See, flexible inflation targeting is a monetary policy framework where the central bank uses its tools, primarily the interest rates, to keep the inflation rate within a specific publicly announced target range. Now, while also considering other economic factors like growth and employment as well. Now, unlike strict inflation targeting, which focuses solely on price stability, the flexible effects or the flexible aspect of inflation targeting, it allows the central bank to tolerate short-term deviations from the target as well, to avoid causing excessive volatility in the real economy. Like a sudden spike in unemployment or a crash in GDP, it is tolerated. And there is a legal backing to inflation targeting in our country as well, where there is Section 45ZA of the amended RBI Act of 1934. It was amended in 2016, and it mandates that the primary objective of the monetary policy is to maintain price stability while keeping in mind the objective of growth. Now, New Zealand was the first country in the world to adopt this inflation targeting framework globally in 1990. And India formally shifted to the flexible inflation targeting in the year 2016, following the recommendations of Urjit Patel Committee, who has been the ex-governor of Reserve Bank of India. Now, since we have very clearly understood about flexible inflation targeting, and the target which we have kept is 4% plus minus 2%. Now, let's understand about the components of this flexible inflation targeting. See, the government of India, in consultation with the RBI, sets a numerical target for the inflation for 5 years. From 2016 to 2021, our inflation target was 4% plus minus 2%. From 2021 to 2026, the target remained the same. And now from 2026 to 2031, again the target would remain the same, 4% plus minus 2%. Which means 4% with a tolerance span of plus minus 2%, actually a range from 2% to 6%. Now, the framework, it uses the headline consumer price index with the base year of 2024 as the primary anchor to measure inflation in our country. Now, the question is, who is the decision maker? See, it's not the RBI, because in 2016, one more thing was done. A monetary policy committee was made to oversee this inflation targeting and to form the monetary policy of our country. And this monetary policy committee, it meets at least 4 times a year to decide the repo rate, the rate at which RBI lends money to the commercial banks to influence overall inflation. And it's the monetary policy committee only which is having an accountability and which is liable to be answering to the government of India as well. See, this monetary policy committee is a 6-membered committee. First member is the RBI Governor. Second member is the Deputy Governor in charge of the monetary policy. The third is a member of the RBI Board, which is selected by the RBI Board, nominated by the RBI Board. And the other 3 members are nominated by the central government. So there are 6 members in total of the monetary policy committee. And if there is a tie, 3:3, in that case, RBI Governor is having a veto. Or we can say that RBI Governor is having an extra vote in case of a tie in this particular committee. Now, if this monetary policy committee fails to meet the target of inflation, and if inflation stays outside of this 2% to 6% band for 3 consecutive quarters, it must submit a report to the government explaining the reasons. So that report, which is to be given to the government by the monetary policy committee, should consist of 3 things. 1, reason of failure. Second, remedial measures which will be taken. And third, estimated time frame for returning to the target. These 3 things are mandated to be present in that particular report, which is set out to the central government by the Monetary Policy Committee. And in the last 9 years, from 2016 to 2025, this flexible inflation targeting followed a hump-shaped performance, with the first and the last 3-year segments remaining aligned to the 4% target. Conversely, the middle 3 years saw an inclination towards the 6% upper tolerance band due to the COVID-19 pandemic, due to Russia-Ukraine conflict as well. But since the adoption of flexible inflation targeting in 2016, average inflation dropped to 4.9% compared to 6.8% in the previous flexible inflation targeting period. Now, since we have understood about this flexible inflation targeting and RBI keeping this target same for the next 5 years, first of all, and RBI keeping this tolerance limit same for the next 5 years as well, let us now talk about theoretically about the monetary policy of our country. See, monetary policy is the process by which a country's central bank, in our case it is the Reserve Bank of India, it manages the money supply and interest rates to achieve specific macroeconomic goals in our country. Now, if there is too much money, if inflation rises, or if there is too low money, the economy slows down. RBI takes into account certain measures, certain policy tools, which will eventually target specific inflation in our country, lead to price stability, and ensuring that macroeconomic stability is maintained. Now, for example, price stability, how it is maintained. Keeping inflation within the target range, 4% plus minus 2%. It protects the purchasing power of the citizens, that is one. Monetary policy also helps in economic growth, ensuring that productive sectors like agriculture, industry, they have access to affordable credit. This monetary policy also leads to exchange rate stability in our country as well, managing the value of the rupee against foreign currencies like dollar and facilitating international trade. So the benefits of monetary policy are a lot. But then earlier I told you that how monetary policy ensures price stability, we need to understand that. For that, we need to know about monetary policy tools. Now, I won't be able to explain all the tools as of now, but we'll be discussing about these tools very briefly. See, monetary policy tools can be classified into 2 types. One is quantitative tools, second is qualitative tools. Now, quantitative tools again further can be classified into 3 types. One is the rates, second is the ratios, and third is the OMOs. Now, the rates, when you talk about the rates, there are 2 rates. One is the repo rate and second is the reverse repo rate. The repo rate is the rate at which central bank lends money to the commercial banks of our country. That is rates. The second one is the ratios. Ratios, you must have heard CRR and SLR, that is cash reserve ratio and statutory liquidity ratio. It basically means the reserves which the commercial banks have to maintain with the RBI, that is cash reserve ratio, with the banks themselves, that is a statutory liquidity ratio, right? So through changing rates in our country, RBI manages liquidity. RBI ensures macroeconomic stability, and RBI targets inflation through changing the rates, either repo or reverse repo. Through changing the ratios as well, by changing the CRR, by changing the SLR. CRR is around 3%, SLR is around 18%. By changing these rates, again RBI targets specific percentage of inflation. RBI creates macroeconomic stability. And the third one is also very, very important. That is open market operations. Now, open market operation means buying and selling of the government securities by the RBI on behalf of the central government. Now, in this particular case as well, either RBI buys the foreign government securities or RBI sells the government securities, again, in order to ensure macroeconomic stability, money supply in the country, and targeting specific percentage of inflation. These are three quantitative tools. Now, there are qualitative tools as well. And qualitative tools are also three. First one is margin requirement, which is the difference between the loan which an individual can get against a particular collateral. The difference between the loan amount and the collateral amount is the margin requirement. RBI, by changing the margin requirement, also changes the money supply in the economy, the loan availability in the economy, the credit availability in the economy, thereby changing the percentage of inflation levels and leading to macroeconomic stability. So that is margin requirement. Other than margin requirement, there is moral persuasion, moral suasion as well. RBI, by giving certain circulars, certain intimations, by giving certain guidelines, by pressing certain steps towards the commercial banks, they can tell commercial banks what to do, what not to do in terms of inflation or deflation in the country. Again, that is very, very, very important. And the last but not the least is the selective credit control under the qualitative instruments, where credit is given to certain sectors and credit is withheld from certain sectors, again, to target money supply, to target inflation, and ensuring macroeconomic stability. Now, these are the monetary policy tools which Reserve Bank of India of our country uses. Technically speaking, Monetary Policy Committee of our country uses in order to ensure macroeconomic stability, in order to target certain percentage of inflation. What percentage we already know, 4% plus minus 2%, and to ensure price stability in our economy. And all these things are working together in order to ensure that the lives of the common people in our country is better off than before. I hope you gained a new perspective from this session. Do let me know what are your views in the comment section. All the very best. Have a beautiful day. Thank you.